Okay, this week's outlook. We'll just go straight into it and start off with the news coming out this week. So on Monday, you've got some US news, nothing major. Some orange folder, slight red folder. Um, yeah, nothing that should really take the markets by surprise on Monday. Tuesday, we've got Bank of Japan meeting minutes, so that will be very key to gain further insight into the March decision. And then June, which one of them should be a hike. And we've got ECB President Lagarde speaking on Tuesday. She's been rather neutral to hawkish as of late, and I don't think the data warrants a pivot to a more dovish meeting. Business confidence out of Australia, ADP weekly in the US. Wednesday is quite a key one for Australia. We have inflation year over year, where we're forecasted to bump up by 20 basis points, which is obviously supportive of the Australian dollar. We've got the Bank of Canada's interest rate decision, which is a forecasted hold, and the guidance will be very key on this, considering the last labour market data report was a bit hit and miss. We also have FOMC on Wednesday, we should see some hawkish pricing into this at the start of the week because, obviously the dot plot, the Fed watch is showing a rate hold, which is widely expected. The Fed press conference is going to be key for guidance, which we think is tilted more to the hawkish side of things, which we will go over. Bank of Canada press conference as well, obviously that's very key, as essentially both the decisions coming out of Canada and the US are guaranteed rate holds, but the guidance is what's going to really tilt this. So let's say we get some hawkish guidance here and some dovish guidance here, you'll see USD CAD do quite well. Thursday we have some red folder from Japan. Retail sales in Japan, quite a heavy day for Japan, where unemployment's expected to remain the same. If you click here, unemployment is expected to remain the same. Retail sales are expected to drop by 30 basis points, however still pretty solid, in my opinion. Going into Friday, we then have GDP Q on Q, so quarter on quarter, and year over year in estimates in Europe, which are looking pretty stagnant. Unemployment's meant to stay the same. Canada's GDP is actually forecasted to do quite well, month over month at least. So that is essentially this week's main data and economic news. However, over the weekend, we'll go into this in more detail, but Trump has obviously threatened 100% tariffs on Canada. So we'll go over the impact of that. So let's go straight into the macro thesis for the week ahead. So, starting off with the dollar, as always. Into Friday's close, we actually saw funds position for increased USD exposure next week. So essentially, there are more inflows into dollar-based equities, funds, all that sort of thing, which indicates that they could be positioning for potential dollar upside this week. Markets are recovering from last week's risk-off tone driven by the Greenland and tariff developments. However, geopolitical uncertainty has not fully receded, with renewed focus now on Iran. The lingering backdrop should continue to support safe haven demand for the dollar. So if you look at the risk sentiment gauge here, we're at 43%, which is like a mild risk-off, which indicates there is still some lingering uncertainty and threat to risk sentiment, which should see the dollar do decently. Obviously, last week we saw the dollar sell off massively due to the whole sell America narrative up into Wednesday, well, rest of the week really, because obviously the tariff threats, etc. But risk sentiment still being at 43% just indicates that the dollar should do pretty well against more risk on currencies. However, that obviously depends how equity is performing. You have to remember that this risk sentiment gauge is also calculated by looking at gold, looking at oil, looking at all these different commodities, And just because gold's doing really well at the moment doesn't mean that means risk on currencies are going to do terrible. So you have to take it. You have to factor it in. You can't just go. Nothing's 1-to-1. So yeah, on the data front, the US macro picture remains constructive. So GDP last week printed above expectations, while recent reactions to NFP, CPI and jobless claims have leaned on the more hawkish side. So if you look at yield reactions here, you can see that from NFP this month, we had a massive reaction to the upside, 75 basis points. Unemployment claims was even bigger, 86 basis points, and then obviously GDP was slightly hawkish. Hawkish repricing in the front end of yield. So yeah, nothing crazy from GDP, but it's signalling upside in yields. That is for sure. Looking ahead, this week's key event is obviously the FOMC meeting, which we have established, with risk skewed towards a firmer policy signal, in our opinion. Some of the reasons for that, obviously we have Atlanta's Fed GDP is tracking at 5.4%, signs of labour market resilience and inflation remaining somewhat elevated, all strengthen the hand of the Fed's more hawkish members, reinforcing a supportive backdrop for the dollar. So if we scroll down here and we look at the labour market in America, you can see unemployment has dropped from 4.6 to 4.4. That's this one here, sorry, 4.6 to 4.4, and then NFP is remaining around the 50,000 mark, 64,000 to 50,000. So it's obviously on the lower end. However, unemployment dropping was very good for yields. Evident from here, well, it was a neutral reaction. However, a couple hours after the reaction, we saw a hawkish repricing. So yeah, and then obviously inflation, although we're falling down towards the 2.7%, we're still quite elevated. I don't think the Fed has ever cut rates in history with inflation at 3%, which is quite interesting. But yeah, and then obviously January we're going to see some nice flows, seasonal wise. Obviously redemptions, subscriptions. That is another factor for a bullish bias on the dollar. Looking at the insights from the bank, they are a lot more bearish. However, they're on a very mid-2026 6-month horizon against the Australian dollar. UBS sees a short-term long opportunity in NZD USD. So yeah, essentially, we're not going to be trading the dollar against the AED, the New Zealand dollar, the euro, because that's a strong currency in our opinion. So yeah. But it's safe to say the institutions are definitely not a fan of the dollar as of now. So yeah, that's everything on the dollar. Moving on to the pound. So this week we have... we don't actually have that much data this week. Last week's data was really the main week for UK data. So yeah, regarding last week's data, we obviously saw a dovish reaction from both the labour market and CPI prints, indicating further downside in short-end gilts, which should bleed into a weaker sterling. Obviously, CPI came in more dovish, and then the labour market was pretty neutral, to be fair. However, it was an initial rise of 8 basis points, which was then retraced. GDP was also pretty standard, came in above the previous reading, but then we dipped. So yeah, that is that. With sentiment this week expected to be on the more risk-off side of the coin, we can also expect the carry trade of the sterling to not be utilised, allowing for rate differentials and a sentiment to drive the GBP, in our view, to the downside. So yeah, I mean, inflation's falling. We had a slight uptick in last week's print. However, if I go here, should be here. Yes, ING. Oh no, it's not here. I was reading an article from ING where essentially they see inflation reaching 2% by April, which reinforces the dovish narrative. The labour market, we have the claimant count pretty elevated and unemployment at 5.1%, which is like a what is it? It's a 5-year high, I believe. So yeah, not the best. Seasonality wise, January's not the best for the pound against the dollar. So yeah, that is essentially everything on the pound with the next meeting in Feb. So yeah, bearish on the pound. Looking at the euro. So for the euro, regarding the euro, last week we saw short end yields move back to the upside, and this week's data looks supportive of further upside. We have German IFO business climate on Monday, which is forecasted to beat its previous reading. CPI and GDP this week also seem supportive of higher short end rates. The threat of tariffs on Europe falling should also remain one of the main risks. Should also remove one of the main risks we had highlighted last week. One factor which is making me sceptical though is that the funds are more neutral on the euro as of now. So yeah, we'll have to monitor inflows throughout the week. But yeah, looking at the institutions, they're all very bullish on the euro, which is great for stuff like euro dollar, euro pound especially. So like, yeah, very, very, very interesting. Like Lloyds Bank are euro bullish against the pound. I believe ING are as well. But yeah, yield reactions wise in Europe, CPI was more hawkish. The December ECB was more hawkish. PMI was interesting. We saw the 10-year rise, but the 2-year fall, which obviously was then retraced with an upside move. And then Lagarde's most recent speech was obviously hawkish. Looking at the labour market, unemployment's dipping a bit. However, we are quite elevated, and inflation's remaining pretty stable around the 2.1%, 2.1% level. So yeah. And then obviously the euro seasonality is the opposite of the DXY. Looking at the CAD, so we are bullish on the CAD. Regarding the new threats of 100% tariff on Canada, which we mentioned at the start, these shouldn't materialise into too much. Trump threatened on Saturday to impose 100% tariffs on Canadian goods if the country makes a deal with China. However, Ottawa, which is obviously a province, I believe, in Canada, where a lot of the government officials are, they have said that it's not going to pursue such an agreement. The only agreement signed with the Chinese and Canada restored the pre-tariff war status quo on select goods like canola and EVs. So in short, any downside should be faded in our view. Sentiment rebounding is going to drive flows into commodity currencies, with the CAD being a main contender. We also have short-end yields remaining well supported from decent economic data, which is obviously great on a rate differential perspective. The labour market data, as I mentioned, slightly dovish, not like a flip in the script dovish, but GDP was solid, CPI was a bit more on the dovish side as well. However, they've all been retraced, which indicates the market's gearing up for better data. Inflation hovering around the 2.8 is still very elevated, which is obviously one good reason why they don't want to cut, or they don't want to have to cut. Unemployment rate shooting up 30 basis points was very unexpected in January. However, I feel like that the markets have priced that in as almost like a one-off, and they do not expect this theme of a deteriorating labour market in Canada to stick around, in my opinion. Unemployment change went from 50k to 8k, obviously still growing, but by a very, very marginal amount. Looking at the Australian dollar, so I'll do the Australian dollar and New Zealand dollar in one whole section together, just because it is both antipodean currencies, both influenced by similar factors. So equities rebounding and the Chinese yuan continuing its strength are all factors pointing towards further Aussie upside. We also have to be aware of the VIX potentially remaining elevated off the Iran, Israel and US tensions rising. Short-end yields continue rising in both Australia and New Zealand amid rate hike speculation and strong economic data. This week's data supports the current narrative, with inflation being forecasted to beat the prior reading by 10 basis points. However, the key to this week is to monitor what flow is driving the antipodeans. Is it the Chinese yuan? Is it equities? Is it commodities? Etc. So, like, obviously looking here at Australia's most recent yield reactions, the labour market data came in very strong in January last week. So we saw a lovely hawkish move, retracing the December data, and then CPI last month came out a tiny bit short, so we had a dovish reaction. However, this week's CPI is looking strong, so we should get a hawkish reaction supporting further upside. Institutional wise, RBC are big fans of the AUD, and so are MUFG. And yeah, I mean, inflation is still relatively elevated at 3.4%. Labour market is clearly improving. I mean, the employment change to 65,000. It was very nice in Jan, and unemployment dropping to 4.1% is great. All signs of a strengthening labour market and economy. So yeah, that's that for the AUD and NZD. Moving over to the Japanese yen. So I'd say I'm bearish to neutral on the yen this week for a few reasons. With rumours of potential yen intervention last week, investors are definitely more cautious on the yen. However, institutions have also reiterated that do not try catch the top, as there's going to be a lot of opportunity to fade the yen upside. What I mean by that is we'll get some pullbacks in like US dollar yen, AUD yen, NZD yen, Swiss yen, but use them as opportunities to fade the strength, meaning go long when you get a nice pullback, because economically, politically, they're still in a very rough position. Nothing's really changed apart from now a bigger intervention risk, which is obviously the 160 handle has been highlighted. But yeah, the twos continue to even rise by that. I mean, the Japanese 2-year yields, the JGBs, even with a less hawkish UEDA in the long end. In the short end. In the long end, we have actually seen the 30-year retrace nicely due to PM Takaichi dissolving Parliament's snap election, which should relieve some stress on the yen in the short term, which obviously was evident from Wednesday to Friday's price action in the yen. We had a nice upside move. However, I really expect that to be short-lived. There's still, just because she dissolved the snap elections in Feb doesn't mean much. Swiss franc. So yeah, that's essentially everything on the yen. We're getting hawkish reactions from every print. However, the terminal rate is just so low, and politically they're in a very tough position. Obviously, Credit Agricole here literally saying the Takaichi trade will be tested by further verbal and potential actual intervention, meaning Takaichi is obviously not in favour of a weaker yen, but her policies contribute to a weaker yen. So obviously now the Bank of Japan are now having to intervene by basically increasing demand manually for yen, which will increase the price. So yeah, that is essentially that. Swiss franc. So with the Swiss franc, we are bullish this week, as we have been. Gold uncertainty remains high. We have geopolitical tensions in the Middle East. America's now with Canada and the US having a slight tussle, and obviously Asia with China. This is just going to continue to send flows into the Swiss franc and gold, which we'll go over. The funds are also showing an increase in inflows into Swiss franc based investments. Another great indication of where the funds are positioning their money. Gold continuing to break all-time highs is another factor supporting our bullish thesis on the Swiss franc, which we believe is here to stick around with geopolitical and Fed uncertainty, coupled with gold's store of value and hedge to inflation. So if I get up trading view on here, if it will let me. Perfect. Alright, we will now go over where we see prices going. So, DXY. There are a few levels I'm interested in. However, obviously with this will be trading the dollar against the euro, which is two strong currencies. So, I think, ignore that. I think we're going to come down to this level here. I think if I get my tools out, here we are. I think we might get a slight pullback from. Hold on. I think we'll get a slight pullback from this handle here, the 97.25. However, that will be faded, and I think we come down here, and then this level here is where we'll get a nice reaction, in my opinion. This is what I have set up. However, we could continue to the upside, and then FOMC will obviously determine whether we continue going up or we retrace back down. So yeah, Wednesday will be key for sure, but I think we can get a nice reaction from the 97.25, potentially 97 handle. So yeah, obviously I won't be trading the DXY because it's the euro against the dollar, as I've mentioned. Now, GBP AUD. This will be definitely a lower time frame play just because it's a very, very weak pair against a very strong pair. I like this demand zone here. I think if we break up the band, 1985 handle, healthy, we could make the stop even a bit bigger, but I think we'll get a lovely reaction here. Could probably even hold it for a 1 to 3 if the data comes out well, with the inflation data out of Australia. But yeah, that is what I'm looking at on GA. Euro pound, I think an upside move is due. I do believe an upside move is due, and I think this handle here is great. I'm not a fan of this price action here. I feel like we could see this get taken and then we go up. Let me move to the upside. Yeah, I like this move, and I think there's a lot of potential in this move, to be honest. I think you could hold this for a 1 to 3 as well. All depends on your entry, because then another potential level was one down here. However, I just don't see us moving all the way down here, in my opinion. So yeah, that's what we're looking at on Euro Pound. Next, we're looking at Pound NZD. Actually, we're not. I'm not looking to take anything on Pound NZD unless we come up to this level here. I'd be looking for something around here. However, I don't really see us getting up here, in my opinion. I'd probably enter on the demand. I feel like something like this could be great. Obviously, commodity currencies, as we've gone over in the fundamental breakdown. But yeah, something like that could be good. Obviously, a lovely scalp here, broke out the bands in a demand. Yeah. So yeah, I'm looking for this. This is what I'm looking for, essentially. GU. This is annoying. I got stopped out on GU on Friday, which was a bit silly taking a position on Friday, but I thought it was. I thought it looked lovely, to be honest. GU. I think we'll get a reaction out of here. I really think we're due a pullback or a retracement almost. Even if we continue going like that, I think we get a pullback from this handle here. Somewhere between the 365 and 37. So yeah, that is GU for me. UJ, definitely a more risky position. I'll be monitoring this as the market moves. But I really like this level here, 154. If we can get in the 154 here, that's a bargain. But I'll be tracking how the price is moving regarding this position here. US 30, which I don't normally take positions on, but I think there is a lovely opportunity here for a nice bounce. Lower time frame for sure, but I think a nice bounce here makes sense. 48,750 if I put that handle in. $48,750. I think that's a great handle. I mean, I never used a fib, but what does the fib show us? Yeah, it's like in the golden zone as well. So yeah, that's what I'm looking for on US 30. I believe that is it. Yeah, that's it for this week. Gold, I'm expecting continued upside, but it's the matter of when you get in. I think this would be a lovely position here, but are we going to retrace that much? Doubt it. Likewise on silver. I mean, we've broken $100. It's mental. It really is. So yeah, I'll have to wait for a lovely pullback. Maybe even have to go on the 15-minute. But I mean, it doesn't look like it wants to really pull back any sooner, does it? US 100 as well, similar style on here, but I'd rather take US 30. I think the price action here is a lot more ugly than US 30. So yeah, that is essentially my outlook for the week ahead. Any questions, leave them in the comments. Obviously, if you want to use the terminal that I am using in these videos, there is a link in the description, and there'll be I'll give you guys a code, so you can get I believe it's 50% off your first month. So yeah, test it out. If you like it, feel free. I mean, we have a bunch of different tools. Obviously, the macro, which I've gone through insights, so you can actually look through what the institutions are saying in more detail. So you can see, all right, here's the analysis. This is what UBS are looking at. This is what Goldman Sachs are looking at. This is what ANZ are, etc. Research, obviously, I post the outlook in here every week. So if we go into weekly outlooks, you'll be able to see here USD bullish, pound neutral, euro bearish, CAD bearish, bullish, that sort of thing. The calendar we've gone over. We have a chat room. Obviously, we have a trading journal as well, so you can actually monitor all your positions, drawdown, number of trades you're taking. You can add unlimited accounts. Obviously, you can connect it there. AI analysis. So basically, I won't do it now, but you can type in a position you're thinking of taking, put in all your thesis, and then yeah, you can click analyze, and it'll give you a score out of 100, etc. And then we actually added a new feature recently called tankers, which is very, very key, especially during tensions between Iran and Israel. So if we're just looking at tankers around the Strait of Hormuz, this will be key if there's like going to be a attack in Israel, or an attack in Iran, sorry. You'll be able to see, okay, tankers, their tankers have stopped moving from here, etc. You can look around. It is very good, in my opinion, in my humble opinion, my non-biased opinion. But yeah, similar to how Bloomberg have their like, I believe they have like a Tesla tracker. They have a tanker tracker, etc. Similar to that, and you can do it to any choke point you want. So Suez Canal, you can go there, and you can see this. So yeah, because then let's say, for example, something happens to the Suez Canal and it gets blocked off, you can then see, all right, well, all these are now going to have to go through this choke point, or they're going to have to go through that choke point. All right, who's going to benefit from that? All right, now you can put money into those assets. That's how you should sort of be thinking. But yeah, that is essentially the outlook done for me. As always, thanks for watching, and yeah, see you in the next weeks.